Hey guys, welcome back to the channel. For those that are new here, my name is Zane and I post weekly videos about wealth creation, real estate, personal finance, and all forms of investing. If you find value in this video, please like, comment, and consider subscribing for more content just like this. In my previous videos, I went into a lot of detail about the state of the Australian economy and the real estate market. So if you haven't already, please feel free to check those out. In today's video, I want to take a deep dive into the future of the Australian property market. We'll do this by looking at all the information that is available to us, some historical trends, some historical data, government programs, interest rates, and just about anything else that we can find that can give us a better understanding of what is going on. Is this the start of another property boom? Or are all the government stimulus programs simply a band-aid for a bullet wound? So without further ado, let's get straight into it. Let's start by talking about interest rates. As we already know, interest rates is one of the most important drivers for real estate growth. When the interest rate drops, it makes it cheaper for us to borrow money, and at the same time makes it less worthwhile for the savers to keep their money in the bank. In the current low interest environment where the average saver is getting well below 2% interest on their deposits, they are losing a lot of money to inflation every single year. When the government suggests that the long-term inflation rate is around 2% and that we are actually heading into a period of deflation, I personally disagree. Housing and rents have gone up significantly in the last few decades, and more recently, we have seen the price of groceries go up 20 to 30% in a single year. It really means that in the current environment, savers are losers. Now let's take a look at where interest rate is headed in the coming years. Based on the seriousness of COVID-19 and the damage that it has done to our economy and economies around the world, government officials and experts are predicting interest rates to stay this low, at least for the next few years. The number that keeps popping up is 3 years, but I personally think this could go on for a lot longer than 3 years, and 4 to 5 or even 6 years is entirely possible. With the banks slashing interest rates and offering enticing refinance offers to attract and lock in new customers at the current rates, it would suggest that the interest rates could go even lower, and I think the possibility of another rate cut before the end of the year is extremely high. While there are those who say we can head into negative interest rates, I personally haven't seen enough supporting evidence to suggest that we are headed for that direction. With that said, if things do get worse in the coming months, negative interest rates could be a last resort for the RBA to use to fight this once-in-a-lifetime economic shock. Let's sum up what long-term interest rates could mean for the market going forward. As interest rates go lower, more money will be borrowed and reinvested into real estate, and therefore driving up real estate prices. And as bank interest decreases, more and more savers will put their money into assets such as real estate to get a better return on their money. The cost of credit is so low now that investors could go buy a cash flow positive property, get a 6 to 7% rental return, and instantly make 2 to 4% profit from just the rental income. And that profit is leveraged by you only putting down a 20% deposit. So in reality, it will be closer to a 10 to 20% return on investment just from the rental income. And I think a lot of investors are starting to do just that. Now let's look at some historical data and how Australian house prices have been affected by previous economic shocks and how long it took them to recover after those shocks. Let's start with the most recent economic shock, the 2008 global financial crisis, which started in America and led to a $22 trillion hit to the US economy. Australia avoided a recession by only experiencing 1/4 of negative GDP growth, but the worldwide credit squeeze was felt by everyone, including Australia. According to CoreLogic, the average capital city property fell by 7.6% over a 13-month period from peak to bottom. When the global financial crisis first hit in 2008, the government was very quick to act. The RBA also supported the market with aggressive interest rate cuts. The rates were sitting at 7.25% just before the GFC. And by mid-2009, the rate had reached 3%. If you look at this graph here, which shows the RBA cash rate timeline, we can see just how aggressively the RBA dropped interest rates after the financial crisis. And as prices started to increase again in 2009, the interest rates were increased. However, after holding the cash rate at 4.75% for about a year, the rates were aggressively dropped again. So why did this happen? Let's take a look at the house prices during this same period. By looking at this graph, which shows the house prices for Sydney, we can see that prices increased sharply in 2009 before peaking in 2010. And this is a trend that we can see in all the other states of Australia. I believe this was directly influenced by the interest rate cuts and government stimulus. And as the RBA started to increase rates again in 2009, the prices started to weaken, and when the rates were cut again in late 2011, it kickstarted one of the greatest bull markets in Australian real estate history. Now we have the two graphs side by side. It is very evident that there is a strong inverse correlation between interest rates and property prices. And whenever the interest rate drops, property prices go straight up. However, there are other things that we must take note of here. First, we were in the midst of a mining boom when the GFC hit, and our economy was very strong heading into it. Second, we had extremely high interest rates in 2008. And the housing market was actually on the decline prior to the global financial crisis. However, if we compare that to the current situation, it is a very different story. Interest rates are already at record lows, so it doesn't have any further to go unless the government is willing to consider negative interest rates. And the state of our economy is definitely very different to what it was back in 2008 when we were in the midst of a mining boom. While the mining in Australia right now is still very strong, it is definitely not as strong as it used to be, and our economy is definitely much weaker. Now that we've looked at the most recent economic shock, let's go back even further and look at the 1990s recession, the recession that we had to have. It all started with the Black Monday stock market crash, which saw the US market drop by more than 20% in a single day. So how did the Australian housing market perform during the 1990s recession? The answer is going to surprise a lot of you. The property prices in most of Australia actually rose during the recession, with Melbourne being the only state that actually experienced negative growth during the same period. By looking at this graph provided by the Australian Bureau of Statistics, we can clearly see the upward trend from the start of the recession in 1989 until the end of the recession in 1993, with Brisbane growing by 6.8% in 1991, followed by Hobart with a growth of 4.3%. When I saw this data, I was just as confused as you guys, so I did a bit of digging into it to see what might have caused this strange correlation. Based on my research, there were three main factors for the growth of real estate prices during these turbulent times. The first reason was, you guessed it, interest rates. The interest rate sat at an astonishing 17.5% at the start of the 1990s and fell steadily throughout the years to support a surge in house property prices. The second reason was the increased supply of credit from the banks. Prior to the 1990s, the banks focused on commercial and business loans. However, with the recession coming, all of those loans were drying up, so the banks now turned their attention towards real estate. This increased focus on mortgages saw a significant increase in the availability of easy credit, which ultimately drove up house prices. The third reason was a change in investor behavior, as investors moved the money from the volatility of the stock market and invested it into the real estate market using the easy credit provided by the banks. These three factors once again led to another amazing bull run in the real estate market after a major economic shock. After looking at these two most recent economic shocks, it is evident that real estate tend to be very resilient during recessions. And after recession, they tend to go on a massive bull run that will last for many, many years. Yes, I know what you guys are saying. The last two economic shocks are very different to the one that we have right now. With interest rates already near zero, the RBA is running out of room to further stimulate the real estate market unless they are willing to go into negative territory. And in my personal opinion, I don't think we will see negative interest rates unless things get very ugly. Another concerning factor is the amount of debt that is tied up in real estate and how hard it will be to service this debt once interest rates do eventually go up. Even with the current low interest environment, a lot of properties in Melbourne and Sydney are still negatively geared. This means repaying these loans will become an issue for a lot of homeowners when the interest rates do rise, which in the long term it will. However, with no foreseeable increases in the interest rate in the near future, this is a problem that can be resolved at a later date when the economy is in a better condition. This is, however, an issue that all home buyers should consider before making a purchase. Interest rates and repayments will go up in the long term. It is only a matter of when. Okay guys, I know this has been a long video, but I just want to make sure we are looking at all the information that is available to us so we can make the best and most informed decisions based on everything that we have. Because buying a property is one of the biggest decisions that we are going to face in our lives. I just want to touch up quickly on two more topics that I think will have a strong influence in real estate prices going forward. And then I want to put all of this information together so we can get a better understanding of what is going on in the market and where it's going to be in 12 or 24 months time. First, I want to talk about unemployment. With the current unemployment figures at 6.5%, it does not paint the full picture because the real unemployment figure will be much higher when the JobKeeper scheme ends in March. However, after taking a deep dive into the newly announced federal budget, there's a strong emphasis on creating jobs, with very good incentives for employers to take on younger workers, which have been the most affected by the recent events. And this will likely balance out the decrease in JobKeeper going forward, with more and more people getting back to work. And in the best case scenario, these new incentives will create enough jobs so that when the JobKeeper program ends in March, it won't lead to a huge spike in unemployment. But a lot can happen between now and then. But with the government committed on creating more jobs and getting people back to work, I believe further stimulus could be introduced, including the extension of JobKeeper. If we take a deeper look into how it's likely to affect house prices, it is likely that it will affect house prices a lot less than we previously thought. Here's why. In the last few months, those who have lost their jobs or those who are at the highest risk of losing their jobs are those in the younger age brackets. And if you look at this demographic, the percentage of home ownership is very low. And this will make a lot of sense because most young people are just starting out in their careers and they usually have to get a few years of work under their belt before they can save up for a deposit or start thinking about buying a house. Another example that we can look at to show that higher unemployment might not necessarily lead to a decrease in house price is if we go all the way back to the 1990s, where unemployment peaked at 11%. And if we go back to the graph of house prices during this recession, we can see that house prices went up significantly during this period of high unemployment because of the increase in money supply, which is also what we are experiencing right now. And finally, let's talk about something that has never happened in Australia before: quantitative easing. For those who don't know what quantitative easing is, it can be summed up as money printing by the government and RBA, which increases the money supply in the economy. This is something that has never been done in Australia before, and it is the latest tool used by the government and central banks to combat the greatest enemy, deflation. Because this is the first time this is being used in Australia, we have no data to look back on or reflect on. We can, however, look at the US economy, which has been using QE since 2008. By looking at the S&P 500, we can see the increase of more than 400% since the global financial crisis. The real estate market also saw significant gains, as well as all asset classes, including cryptocurrency and precious metals. So with QE being introduced in Australia, we are likely to see a similar trend in the coming years. Another thing that we can take away from this is because that quantitative easing is being used by so many countries, and to such an extent, we are unlikely to see an increase in interest rates as the central banks around the world try to keep it as low as possible to make it easy to service all of this debt. Alright guys, we are almost at the end of the video, so let's put all of this information together. Interest rates is one of the strongest drivers for real estate growth, and with interest rates at record lows, it could suggest further price growth. Based on historical data and trends, real estate in Australia tend to be very resilient during economic shocks. Real estate prices tend to go up significantly after major economic shocks. High unemployment figures tend to have a much lower effect on real estate prices than we originally thought. And finally, QE tends to drive up property prices. A lot of you guys know I'm very bullish on property, and I want to let you guys know that I'm bullish on property because of the numbers, the statistics, the trends, and the macroeconomic factors, and I've just shared all of those with you guys. I know a lot of you guys are going to disagree with this, and that's okay. This is simply my opinion based on my research and my investment strategy. I don't expect everyone to agree with me, but if you don't agree with me, I would love to hear why. Please leave a comment in the comment section below, and I would love to chat with you guys. And finally, I am not a financial advisor, and this is definitely not financial advice. I'm just an Asian guy who makes YouTube videos for fun. And that brings us to the end of the video. If you found value in this video, please do me a favor, hit that like button, comment your thoughts below, and consider subscribing for more content just like this. And I'll see all of you guys in the next video.